Forget everything your financial advisor told you at that awkward holiday party, because we are about to blow up one of the most heated debates in personal finance. Active investing versus passive funds. Two camps, one winner. And the answer might genuinely surprise you. Every year, billions of dollars flow into actively managed funds with the promise that some genius in a suit is going to outperform the market on your behalf. But here's the uncomfortable truth. Over any given 15-year period, roughly 90% of active fund managers fail to beat their benchmark index. Think of it like hiring a personal chef who 9 times out of 10 just reheats a meal that a vending machine could have delivered cheaper and faster. Meanwhile, the passive index fund is just sitting there quietly, boring, dependable, and quietly compounding your wealth like a tortoise that somehow owns real estate. The optimism around active management was real and intoxicating in the 1980s and 90s, when star managers like Peter Lynch were turning 28% annual returns into legend. But that era faded, markets became more efficient, and the information edge that once separated the pros from the crowd essentially evaporated. Psychologically, active investing does something seductive to your brain. It makes you feel in control, like you are doing something. Nobel Prize-winning economist Daniel Kahneman would remind you that that feeling of control is often the most expensive illusion you will ever purchase. Now, passive investing is not without its critics. And let us be fair, when every retail investor piles into the same index, you get a kind of crowding effect that some economists find genuinely concerning. But historically, through crashes in 2001, 2008, and 2020, diversified index funds recovered and rewarded patience every single time. Here is the pattern you need to internalize. Markets go up, markets go down. Active managers panic, fees compound, and the index just keeps doing its thing like it has absolutely nothing to prove. Warren Buffett literally bet $1 million against a hedge fund manager in 2008, and the index fund won by a landslide over 10 years. A common misconception is that passive investing means you are settling for average, but average in the stock market, compounded over 30 years, is actually extraordinary. You are not getting average results. You are getting market returns minus almost nothing in fees, which is a very different and much more powerful statement. The practical lesson here is that the biggest destroyer of long-term wealth is not market downturns. It is fees, taxes, and emotional decisions made during volatility. A 1% annual fee sounds like nothing until you realize it can consume roughly 28% of your final portfolio value over 30 years. That said, active hands-on investing in real assets, think real estate, small businesses, or direct lending, is an entirely different conversation that passive stock funds simply cannot replicate. Real estate gives you leverage, tax advantages, cash flow, and the ability to force appreciation in ways no ETF ever will. So the smarter question is not which one is better in absolute terms, but rather which vehicle fits which goal in your specific financial architecture. Passive funds for market exposure, disciplined and unemotional, direct investing for cash flow, control, and asymmetric upside both have a seat at the table if you are strategic about position sizing. The philosophy here is simple. Consistency and process beat conviction and timing every single time, which is something both passive investors and disciplined active investors can agree on. Size your positions to survive being wrong. Stay in the game long enough to be right, and let compounding do the heavy lifting. Markets will cycle. Managers will promise alpha, and financial Twitter will absolutely lose its mind every quarter. And through all of it, the boring, disciplined investor who stayed the course will quietly win. Passive or active, the real edge is always emotional discipline and a strategy you can actually stick to when things get ugly. At the end of the day, the best investment strategy is the one you understand, believe in, and can execute without panic selling at 2 in the morning. Whether it is index funds or direct deals, your job is to show up consistently, stay rational, and trust the process over the emotion. If you're ready to go beyond passive funds and explore real estate investing, contracting opportunities, or connecting with the right lenders, we can help you get started. Check out our links in the description below.